sometimes simplifying things and assuming no growth or constant growth from, here you are times zero, you got this next dividend, and then after that it grows at a constant rate or it doesn't grow at all, it's not appropriate. You might have a company involved in a turnaround where it's going to have some tough years and then it's going to turn things around and then it's going to stable out. Or you have a fast growing company. It's a new industry, a new company. It's growing like gangbusters. But at some point, the industry is going to mature, the firm's going to mature, and things are going to slow down. In these situations, a appropriate model would be the non-constant growth in certain cases. You can also think of it as a delayed growth model. And the basic idea is that for a certain number of years, as of from today, kind of those early years, you can assume any pattern of dividends. Dividends, they don't have to follow a pattern. They can, analysts often use this where they'll go in and really pore over the income statements and balance sheets and projections and really try to figure out what the company's performance will be to come up with dividends for, the next year, 2 years, 3 years, whatever. Then you start to get some point in the future where it really becomes counterproductive and unproductive to try to figure out what's going to happen because there's just too much uncertainty. And then you assume constant growth. Constant growth could be zero, could be positive, or could be negative, but once you assume constant growth, then we can use some of the models that we've talked about. So here's the basic idea, and it takes advantage of two things that have been reviewed. One is that at any point in time, the price of a stock can simply be computed as the present value of the expected dividends for some period of time and the expected price of that stock at the end of that, those periods of time. So again, you got a dividend in one period, discount it, 2 periods, discount it all the way out to at the very end you get that last dividend in the morning, you sell the stock in the afternoon, and then you're done. So we've talked about this. But the question is, and it's even got a question mark here, is what is the expected price at time n? Well, in some cases we have tools to get it. Suppose we have a case where we have this next dividend and then after that it grows at a constant rate, then we can find the expected price at time n simply as the next dividend all over r minus g. So if the dividends follow this pattern, then we actually can find the price at time n, expected price at time n, and now we've got all these dividends, we've got the price at the end of this period, these periods of time, we can discount them and we can get the price. And so again, that lays out all the definitions. So what if we want to price a stock and we want to use the non-constant growth model? Well, I've laid it out in 4 steps. First step, draw a timeline. Second step, we want to find what I call the anchor dividend a lot. It's the first dividend, and this dividend gets paid. And again, it's useful to find that first one, that first expected dividend, and then after that, they all grow at a constant rate. And we're going to call that dividend dn plus 1. So if we were to go to this period of time, you can see we've called it dn plus 1. That's our first dividend, our anchor dividend, and then after that, we get constant growth. And the reason we do that is step 3 is we can then figure out the price of the stock at time n because we've got the next dividend, which is dn plus 1 over r minus g. And why can we do that? Again, the picture helps. Why can we get the price of the stock as of time n? Because here we are at time n, and what do we see? In one period, we've got this dividend, and then after that, the dividends all grow at a constant rate. So it's appropriate to use this model if we've got this dividend, and then after that, the dividends all grow at a constant rate. And so then finally, we just put it all together and we discount all of those dividends up to the point where we have this price. And a couple of things to note so the first kind of the anchor dividend, we're going to get the price as of one period before what I call the anchor dividend. So therefore, when we're discounting all of these dividends in the price, this anchor dividend doesn't actually enter in to this equation. The second, we use the anchor dividend as of time n plus 1. It's tempting sometimes to then discount the price by n plus 1, but remember, you're finding the price as of 1 year before that initial dividend, or that anchor dividend, and so you're getting the price as of time n, so you're going to want to discount by n periods. So let's take a look at an example. So we have ABC stock. We went over the price today. It has expected return of 15%. It's going to grow quite nicely initially, $1 in a year, then $2. It's going to double to 2. Then it's going to increase by 50% to 3. Then it's going to increase by 33% to 4. And then after that, the company is going to have considered matured, and dividends are going to grow at a much more modest pace of 5% forever. So what's the price? Well, first step, do a timeline. So again, you got 1, 2, 3, 4, and then 5% growth forever. But what does that mean? It means the dividend that we expect in 5 years is $4 times 1.05, which is 420. Here it's 420 times 1.05, or $4 times 1.05 squared is 441, and then it's going to just continue forever and ever and ever. Step 2 is to find the, I'll go to blue. Step 2 is to find the anchor dividend. It's the dividend, it's the one, and it's the $4 because the $4 gets paid, and then after that, all of the dividends grow at 5% forever. So if we have the dividend of $4, then they all grow by 5% forever. That's what that lays out. Then we can find the stock price as of time 3. And what's the price at time 3? The expected price at time 3 is equal to the expected dividend at time 4 over R minus G, which is $4 over 0.15 minus 0.05, which is $40. So we know that the price as of time 3 is expected to be $40. Why? Because if you took your time machine out there, $3 gets paid in the morning, you get out and you say, aha, look, in one period I expect $4. Then after that, all those dividends are going to grow by 5%. So as of time 3, my stock is worth $40. And that's what we lay out here. Again, time 3, 1 period later, R minus G gives us $40. Well, now, what do we have? What is the price of a stock that's expected to pay dividends of $1 in a year, $2 in 2 years, $3 in 3 years, and then be priced at $40 in 3 years with an expected return of 15%? That is simply equal to, well, we got a nice picture here, $1 in a year, 2 and 2, 3 and 3, plus 40 in 3, $30.66. And again, you get the $40 based on the dividend in 4 years, but you discount, but it's the price in 3 years, so you got to make sure to remember to divide it by 3 and don't include the $4 dividend.